Wall Street had a pretty crazy day,
It did.
especially for tech stocks. The Nasdaq soared past a major milestone,
Yeah.
closing above 20,000 for the first time ever.
I know. It's pretty remarkable.
It is. What drove this surge, especially considering the November CPI report showed rising prices?
Well, that's the thing. The CPI report did show a rise in prices, but it was largely in line with market expectations. So, it actually eased investor concerns about runaway inflation and fueled a rally.
So instead of spooking investors,
Yeah.
the CPI report actually boosted their confidence.
Mm-hmm.
How does that make sense?
It's all about the Federal Reserve and interest rates. The market interpreted the inline inflation report as a signal that the Fed might be nearing the end of its rate hiking cycle.
Meaning a rate cut could be on the horizon.
Possibly.
And that's why the market reacted so positively.
Exactly. The odds of a rate cut actually jumped after the CPI report, which, added fuel to the speculation that started after last week's jobs report. Lower interest rates make it cheaper for companies to borrow money, potentially boosting investment and growth, which makes stocks more attractive to investors.
This makes sense, especially for tech stocks.
Uh-huh.
They often rely heavily on borrowing to fuel their growth.
Right.
A potential rate cut could be seen as a green light for further investment in the sector.
Absolutely. That's why we saw companies like Tesla hit record highs.
Tesla's performance has been pretty remarkable.
It has.
What's driving their continued success besides the potential for lower interest rates?
Well, Tesla is benefiting from a confluence of factors. They've been reporting impressive delivery numbers, demonstrating strong demand for their electric vehicles, and they're also aggressively expanding their production capacity to meet this demand.
So they're executing well on their business plan,
They are.
which is further attracting investors. It's not just Tesla, though. Other tech giants like Nvidia, Alphabet, and Amazon are also riding this wave.
Yeah.
What's behind their continued strength?
These companies are all major players in the tech sector, benefiting from the same positive sentiment that's driving the overall market rally. Investors see them as having strong growth prospects, well-positioned to capitalize on emerging trends like artificial intelligence, cloud computing, and e-commerce.
It seems like a pretty rosy picture for tech right now.
It does.
But are there any areas of the market that are lagging behind?
Not all sectors are flourishing. Pharmacy benefit managers, companies like Cigna, CVS Health, and United Health Group, took a hit following news of a bill that could reshape their industry.
Could you elaborate on that?
Well,
What does this bill aim to do, and why is it impacting these companies negatively?
this bipartisan bill aims to increase transparency and competition within the pharmaceutical supply chain. One of its key proposals is to force health insurers or drug middlemen to divest their pharmacy businesses.
How would this impact their profitability?
Well, pharmacy benefit managers act as intermediaries between drug manufacturers and health insurers, negotiating drug prices and managing prescription drug benefits. Divesting their pharmacy businesses could disrupt this model, potentially reducing their negotiating power and revenue streams.
This is a great example of how regulatory changes can create uncertainty and impact specific sectors, even in a bullish market. Not all stocks move in the same direction.
Precisely. It highlights the importance of diversifying one's portfolio and considering both macroeconomic factors and company-specific news when making investment decisions.
Speaking of company-specific news, were there any other interesting stock stories that stood out?
Absolutely. GameStop surprised many by recording a profit for the third quarter. This was driven largely by cost-saving efforts signaling a potential turnaround for the company.
That's quite a contrast to their meme stock frenzy days a few years ago.
Yeah.
What's driving this apparent shift?
It seems GameStop is focusing on its core business, optimizing operations, and finding ways to become more profitable. They've closed underperforming stores, streamlined their inventory, and are investing in their online presence.
So a more strategic and disciplined approach.
Yeah.
Any other notable movers?
Broadcom had a great day, jumping over 5% on news that they are working with Apple to develop its first server chip specifically designed for artificial intelligence.
That's a major win for Broadcom, aligning themselves with a tech giant like Apple in such a burgeoning field.
It signifies confidence in Broadcom's technological capabilities and opens up new growth avenues for them in the rapidly expanding AI market.
It's fascinating to see these individual company stories play out against the backdrop of the broader market trends. We have GameStop potentially making a comeback, Broadcom riding the AI wave. But were there any companies facing headwinds today?
Yes, Macy's, the department store giant, lowered its profit forecast, citing persistent weakness in consumer demand. This has raised concerns about consumer spending during the upcoming holiday season.
What factors are contributing to this weakened consumer demand, especially during what is typically a strong shopping period?
Several factors could be at play. Inflationary pressures and economic uncertainty are likely weighing on consumer confidence. People are being more cautious with their spending as their budgets are squeezed by rising prices for essential goods and services.
So while the tech sector is celebrating, the retail sector is facing some challenges. This raises an important question. Is the market getting ahead of itself with all this exuberance, especially given the potential warning signs from the retail sector?
That's the million-dollar question. It's possible the market is overly focused on the potential for a rate cut and not paying enough attention to these underlying economic concerns.
So we're seeing this interesting divergence between the market's optimism, especially in the tech sector, and the more cautious outlook from sectors like retail. What should investors be watching for in the coming weeks and months to better understand how this might play out?
It's crucial to keep a close eye on consumer spending data. If we see a significant slowdown, particularly during the holiday season, that could be a red flag for the broader economy.
What about inflation? The Fed has been laser focused on bringing it down.
Right.
Will they really cut rates if inflation remains stubbornly high?
That's another key factor to watch. The Fed has made it clear that they're committed to their 2% inflation target. If inflation doesn't show convincing signs of cooling down, they might hesitate to cut rates even if economic growth slows.
So it's not as simple as a rate cut being good for the market. It really depends on the broader economic context and the Fed's assessment of inflation.
Exactly. The Fed has a delicate balancing act to perform. They want to support economic growth, but also need to ensure price stability. Their decisions will be heavily influenced by the incoming economic data.
This suggests there's still a lot of uncertainty in the market despite the recent rally.
Absolutely. We're in a dynamic environment with a lot of moving parts. Investors should be prepared for continued volatility as the economic picture unfolds.
This brings up another point. The market seems to be betting on a Fed pivot towards rate cuts. But what if the Fed holds firm or even continues to raise rates? What impact could that have on the market,
Well,
particularly on the high-flying tech sector?
that's a critical scenario to consider. If the Fed doesn't pivot as the market expects, we could see a significant correction, especially in those sectors that have benefited the most from the anticipation of lower rates.
Tech stocks in particular come to mind given their sensitivity to interest rate changes.
Precisely. Their valuations often depend on future growth expectations, which are heavily influenced by the cost of capital. If rates stay high or go even higher, it could make those growth projections less appealing, leading to a downward adjustment in their stock prices.
This all points to the importance of understanding the interplay between the Fed's monetary policy, inflation, and investor expectations.
It's a complex dynamic that drives market movements. Investors need to stay informed about these factors and be prepared to adjust their strategies accordingly.
So what key takeaways can we distill from all this for investors navigating this uncertain terrain?
First and foremost, diversification is key. Don't put all your eggs in one basket, especially in a volatile market.
That's timeless advice, but especially relevant right now. What else?
Stay informed. Pay attention to economic data releases, Fed statements, and geopolitical events. These can all have a significant impact on market direction.
And probably don't get caught up in the hype of any single sector or stock, no matter how tempting it might seem.
Exactly. FOMO, or the fear of missing out, can lead to impulsive decisions. Stick to your investment plan and don't chase short-term gains at the expense of your long-term goals.
Sound advice. It seems like the message here is to approach the market with a healthy dose of caution and a well-thought-out strategy.
Indeed. It's a marathon, not a sprint.
This market roller coaster ride seems far from over.
It does.
It'll be interesting to see how this all plays out.
Yeah, it will.
Well, thank you for breaking down this market mania. This has given me a lot to think about.
You're welcome. It was my pleasure.
That's all the time we have for today. Thank you for joining us on this market journey.
Thanks for having me.
Goodbye, and see you in the next video.